incorporated live on Channels Television. Here's what's coming up in the next 55 minutes. Credit rating giant Fitch shares optimism about Ghana's banking sector recovery amid robust earnings. And Kenya set to shift all counties to a Treasury single account. Plus, gold prices near one-month peak as rate cut hopes grow. Hello, welcome to the program. Let's get a check on what's playing out in the oil market. We're seeing oil prices continuing that upward momentum today, climbing for a second consecutive day as a larger than expected drop in U.S. crude stockpiles. That's boosting sentiment now. 0.4% up, that's for Brent crude, $82.33 a barrel. Seems Brent might be trying to get comfortable above $80 at this point. We'll see if that holds. WTI, that's the U.S. grade, $80.36 a barrel, not looking strongly above the $80 level, 0.4% up. So we're seeing data showing the longest streak of declining U.S. crude inventories. That's since July 2021, and that's weighing on prices right there, giving a boost for the bulls to take over again. To other stories now, the Organization of Petroleum Exporting Countries says the Dangote Petroleum Refinery and its efforts to ramp up premium motor spirits production is impacting the PMS market in Europe. The 650,000 capacity Dangote Refinery, which began operations in January last year, started producing PMS in September, years after the country had relied solely on importation for its fuel needs. According to OPEC, the emergence of Dangote Refinery has reduced the importation of petroleum products from Europe to Nigeria. Meanwhile, the monthly oil market reports disclosed that the average daily crude production in Nigeria hit 1.5 million barrels per day in December. And to the metals market now, we see gold is holding steady today after soaring to a one-month high, driven by a weaker than expected U.S. core inflation data that fueled hopes for interest rate cuts. And we see spot gold there on chain, $2,696 per ounce, still a little close to the $2,700 level. U.S. gold futures, that's looking better, $2,725. That's up 0.3%. Other metals we track in the market there, we see silver down 0.2%, $30.61 per ounce. Platinum unchanged, just like the spot gold. Palladium 0.3% down, $958.50, below that $1,000 psychological level. So that's how the metals market is looking today. We'll see how the trade continues for the end of to the end of trade for today. Well, reactions have been trailing the preliminary data released by the National Bureau of Statistics, which indicates that real estate has now surpassed oil and gas to become the country's third largest sector. This follows the rebasing of the GDP and CPI data. A player in the industry and chief executive officer of Xylus Group, Dr. Oluwatosin Olatujoye, is optimistic. The trend of development in the sector is asking for more intervention by the government. It was a guest early on Business Morning today. Take a listen.
In 2023, the contribution of real estate to the GDP is about 5.58, the entire 2023. And in 2024, because of the reduction in the purchasing power of the economy, we're all thinking that probably the real estate sector will be low. But meanwhile, last year also, based on the third quarter report, we are still 5.43 in the GDP contribution. So what that means is that a lot of people are interested in buying real estate. But the challenges they are having is basically affordability and flexible payment plan and a long-term duration to pay. So if we can solve these 3 points, then the housing deficit that we have at the moment between 20 million to 28 million can be reduced. Market that really need housing, the market making up this housing deficit we are talking about is between middle and low. The high ones can afford to buy houses for themselves. And the middle and low, if you look at the income they earn from their salary on a monthly basis, can they easily afford to pay for a particular house they want to own for themselves. No, because the kind of house that are available in the market are not affordable. So as a real estate developer in the industry in Nigeria, we need to start looking towards building some houses in some strategic location, because you cannot build house in Ikoyi or in Lekki Phase 1 and expect the value of the house to low.
All right, to our first conversation now, Nigerian consumer goods sectors navigating a complex landscape of challenges and opportunities, despite facing headwinds from inflation, currency devaluation, and rising input costs. The sector witnessed significant nominal growth in 2023. This now will delve into key drivers of growth from previous years into 2024 and what to expect for 2025, and explore strategies for mitigating the impact of external shocks. At this point, joining us is Nathaniel Disu, investment research analyst at AfriInvest, joining me from Ikoyi via Zoom. Great to have you on the show. Good afternoon.
Yeah, good afternoon, Ladi. Good to be on the show again.
Yeah, so from getting inflation data for December yesterday, most analysts have said this inflation data kind of beats expectations. You know, at this point, most people were expecting inflation would get to about 35% in December, you know, considering all of the spending, you know, for dirty December. Speak to me about that. How are analysts, you know, viewing this December inflation before we go into consumer goods?
Okay, thank you very much. So just recently, a few days ago, the MPS released the inflation data for December, showing that that the headline inflation rose to 34.8%. And despite the fact that December had a lot of economic activities in terms of the entertainment industry, which was largely failed by the dirty December craze. So we saw that there were a whole lot of activities, and it's not surprising that inflation still went up slightly last year. For that was for the month of December. But looking at the rebasing exercise that the MPS did last week, Thursday, I think, if we look at the rebasing exercise in the computation of the index, if you look at the core basic amenities for human beings, that's food, shelter, and also clothing, you could say that the rating of those indexes was reduced. It was reduced, and that is not really that doesn't really reflect the true state of the average Nigerian consumers, because if you look at it, the amount an average Nigerian spends on food has gone up. The amount an average Nigerian spends on clothing and also shelter in terms of accommodation has also gone up. So looking at the rebasing exercise that the CBN did, if you look at other segments of the index, for example, restaurants and accommodation, that went high, which is quietly understandable. But looking at those three core index, that is food, that could likely see a decline in food inflation, especially this coming month. But that doesn't reflect the true state of the economy in terms of prices of goods and services. We could see that price of foods is still going up, prices of clothing and shelter is still going up. So despite the fact that people are still spending more on these basic amenities, in the rebased CPI index, we could see that the weighting of these three categories has already gone down.
All right, let's look at the consumer goods sector now. What would you say are the key factors, you know, contributing to the significant nominal growth in Nigeria's consumer goods sector, you know, despite the challenges, you know, we've seen posed by inflation and currency devaluation?
Okay, yes, concerning the consumer goods sector, just like in the reports that we published, the AfriInvest consumer goods reports that we published just last month, we looked at different drivers of the consumer goods sector, and we would say that despite the macroeconomic headwinds that is currently happening in that sector, we could see that players are still able to drive up revenue. If you look at the full year results in 2023 and also half year 2024, you would see that the major players, didn't really find it difficult to get revenue. They were still able to make a lot of sales despite the economic situation. But the major headwinds that's affecting that sector is rising cost of raw materials and also FX volatility. Those were the major drivers that affected that sector. But based on the reports that we just published, we could see that despite all these headwinds, there are some players that are still making significant wave in that sector. For example, Boa Foods just last year did about 100% growth, that's in the share price alone. And if you look at their figures, that's in terms of other players in that sector, most of them recorded negative shareholder fund, negative profit after tax. But Boa Foods did about over 100 billion naira profit after tax. So we could say that there are still a lot of opportunities in that sector. Also in the sugar subsector, we could see that there are still some opportunities depending on how well players are able to be flexible in terms of pricing dynamics and meeting the needs of the average Nigerian.
And, talk to me about how, the Nigerian consumer goods industry can mitigate the impact of foreign exchange volatility. We remember, 2023, 2024 was all about FX losses, and we're also seeing rising input costs. All of that, playing on profitability. How can they wing it in 2025?
Okay, yes. So for this year, that's also one of the things that we highlighted in our report, that despite the FX challenges that is affecting players, there are still some strategic moves that some industry players can either implement or also fast track to mitigate the impact of the FX volatility. One of the major drivers that they can do is backward integration project, which is what we've been seeing in players like Dangote Sugar, Unilever, and Nestle. So, for example, Nestle's foreign exchange losses, one of the main reasons why Nestle recorded negative shareholder fund is that they have high exposure to FX. Most of their loans, about 90% or so of their loans, were from their parent company. And due to the FX volatility, that would have an impact on them. So if major players can able to look inwards, that's where the backward integration project comes into play. They're able to source for most of their raw materials locally, which is what Unilever is doing. For example, if you look at Unilever and Nestle, they're into similar line of business, especially for the food aspect. But Unilever still recorded positive profit after tax for 2023 full year and also half year 2024. But Nestle, on the other hand, they recorded negative shareholder fund. So backward integration project and reducing exposure to FX are one of the mitigating factors that major industry players can do to experience stability. Although, if you look at it on the positive side also, the effect of FX volatility that we saw in 2024 is not going to be the same in 2025. So we're likely to see a bit of stability this year in terms of the consumer goods sector, especially for their books. But this year is just more like a stability phase. It doesn't still show that they are out of the danger zone yet. So this year's financial statement, especially the Q1 numbers and the half-year numbers, is going to give a true reflection of the state of the consumer goods sector, if they are able to mitigate these challenges or if they are still in the danger zone.
Let's look at the exits, from that sector. We had a couple of multinational companies, like Unilever, P&G. They did, exit the market. Talk to me about the long-term development, of the Nigerian consumer goods sector, with some of these exits that we've seen.
Okay, yeah, thank you very much for that. So in terms of the exits, that's still one of the things that we are keeping track of in the consumer goods sector. So, for example, in the home and personal care subsector, which we highlighted in our report, two of the major listed players in that sector is Unilever and PZ. But Unilever, they've already exited the personal care business of their business. They did that in 2023, and in yes, 2023, 2024. But also late last year, we saw that PZ is already beginning the process of looking at the possibility of exiting Africa. Yeah, so that would actually put a strain on the entire home and personal care business, because if PZ eventually exits and Unilever's position in that subsector also exit, there will not be any major players in the home and personal care sector on the index, that is on the listed companies. So there are a lot of opportunities out there also in terms of the home and personal care business. But if we still see more multinationals leaving Nigeria this year, it's going to cast a lot of strain further in the consumer goods sector, and the outlook will continue to be bleak.
All right, let's look at a particular segment now of that sector. That's the sugar industry, and there's some competition brewing there. Talk to me about how, Dangote Sugar can respond to growing competition from Boer Foods and, maintain its market leadership.
Yeah, so in terms of the sugar industry, that's one of the fascinating subsectors in the consumer good index, which was what we also highlighted in our report. For the past couple of years, I think 3 years or so, Dangote Sugar has been the major market leader in that space. But just last year, we saw that Boer Foods is gaining more grounds in the sugar industry, and based on our own projection, we are expecting Boer Foods to become the new market leader in the sugar industry. And one of the things that Boer Foods is doing differently compared to Dangote Sugar is that they are adopting more of business to customer strategy, B2C strategy. They are doing more in that space compared to Dangote Sugar, because if you look at their financial statements, retail sales, Boer Foods did more in terms of a retail sales than Dangote Sugar last year. That's 2023 and also half year 2024. So particularly half year 2024, we saw that Boer Foods made more revenue in terms of sugar sales than Dangote Sugar. So we are expecting that in 2025, Boer Foods is going to become the new market leader in the sugar industry due to their strategic moves in terms of the business to customer strategy and retail sales. So that's one of the reasons why we are expecting that to happen. Because if you look at the charts showing on the screen, Boer Foods is the one with light blue, has 269 billion naira, while Dangote Sugar, which is the dark blue at the bottom, has 292. So we could say that in 2023, the gap was really, really tight, but in half year 2024, we saw that Boer Foods already eclipsed Dangote Sugar. So by the time the full year numbers of 2024 will be released around that February thereabouts, we are going to expect that Boer Foods will become the new market leader in terms of the sugar subsector in the consumer goods sector in Nigeria.
Right, and talk to me about strategies that the Nigerian government can implement to support domestic sugar production and reduce reliance on imports.
So one of the things that the federal government can do to support the moves is to make the business environment friendlier to major players, because like we've already talked about, one of the major challenges that the consumer goods sector is facing is high cost of raw materials, sugar imports, which is backed up by the FX volatility. So if the FX price is stabilized, that can also make things easier. And also in terms of the backward integration projects, the federal government can also assist the major players in that space, because by the time they are doing more locally, it would reduce the exposure to FX and the effect of FX volatility, and that would see major players posting positive bottom line figures.
All right, definitely a lot to look out for in 2025. Hopefully we won't get headlines when we're seeing those earnings about FX losses, since we've seen the Naira being quite stable. But thank you so much, Nathaniel Disu, investment research analyst at AfriInvest. Thank you.
Thank you very much, Ladi.
All right, let's go straight to Custom Street, right there at the NGX trading floor. We have our very own Anete on that side. Hello, Anete. And how's the energy right there at the NGX?
Yes, good afternoon, Ladi. Live from the NGX here. The energy, I would say, when you look at starting from yesterday, which was midweek of the second full trading week of January for the market, you saw that number coming all the way from the 103,000 points to 102, and then at intraday we saw the market, if we can have that on the screen, down by 1.20%. And that is also, that energy, I don't know whether to say it's profit-taking or what factor, because so far from the start of the week down to Thursday, we still see that weakening of the market. So I would say that energy has weakened, and also when you also take a look at the latest inflation reports.
All right, and I'm sure you have a lot packed for us right there.
Yeah, so we'll be giving you that details about that, and of course what to expect, because the market is really in a way that you really can't really explain. But let's talk about the numbers first. We see the NGX All Share Index last track 1 hour ago, 1.20%, 100,867.56. For the Johannesburg Stock Exchange, it was up by 0.2%. And climbed its way back into the 83,000 level, and still trying to make that comeback a little bit higher. For the other two markets, what I have here is that the EGX 30 was up by 0.89%, 29,650.42, while for the close of Wednesday's trading session, we saw the Nairobi Stock Exchange All Share Index about down by 0.20% at 129.47. So that's a snapshot for the markets at intraday and at close for the Nairobi Stock Exchange. But let's talk more about the market this time. And we have live from the studio, our studio here at the Nigerian Exchange Limited, Mr. Tajuddin Olainka, who is an investment banker as well as a stockbroker, to tell us more about the market. Thank you for joining us, Mr. Tajuddin Olainka.
Thank you, it's my pleasure.
Okay, so I want to ask my first question. We saw that inflation number coming not too high, but still higher than what we saw in November at 34.84%. So now, how did the market react to this, which we've seen profit taking? We've seen the market decline for about 3 consecutive sessions and into intraday.
Okay, yes. Quite frankly, market anticipated, the just minor push up in the inflation number, and so market has not actually reacted to that number, because it has anticipated it. If it had gone down slightly, then we'll have seen a different market. But market is actually reacting to some of those things that are not actually totally in agreement with what market expect. For instance, that some of these public offers by some of these banks started way back in June. Let's look at Fidelity, for instance, which application list was opened in June. But up to now, that stock has not. Those shares have not been listed. So, which means that even if they list them today, nobody is sure of what they can make out of it. So those delay listing, arising from capital verification by central bank, actually, slow down the usual year-end rally that we should normally have in December. In fact, sometimes you could have it in November, but this time around we had it just close to end of December, and so that is the reason why you see that fatigue. The fatigue we see in the market is just because some of those shares that were offered to the public are yet to be listed, and investors are not having hold of those shares. They cannot trade them, they cannot do anything, and they cannot make money out of it. So that's also what is slowing down the kind of rally that we normally should see around this time. It's actually a delay rally.
Okay, so now, when you consider some, the economic news, and we're supposed to be in earnings week, and the U.S. earnings week is the earnings season has already started. So, what other factors could be driving the markets down? The market is down by about 0.81% year to date. So, what are the factors besides this? What you just mentioned to our investors?
Okay, quite frankly, you cannot take away, because we know the kind of result we are going to be getting in the next 1 month, especially February or maybe up to March for some of these companies. Those that will make those that we know that to be more profitable already showing that sign, and we saw that in their third quarter. We saw a company that made 1 trillion half year. GTCO, but yet its offer was undersubscribed. So you see, once market is not in alignment with some of those fundamentals around the economy, of course you see some reaction. But clearly, what is happening is that when you don't have offer, public offer going the direction that it should go. Normally, when offer opens and the application list closes, as soon as let's say it closed today, in the next 3 weeks or say the next 1 month, there should be allotment. So all these things are actually discouraging investors from, pushing ahead, doing new things in the market. Some of these investors actually either they took loan or they sold they stole stock from other companies to be able to subscribe to those shares. So if they don't have those shares and they cannot trade them, of course they cannot make new money to be able to take position in other stocks. So clearly those are the things that are actually affecting the market. It's not a serious issue. I think CBN should just be up and doing this capital verification so that we can have offer. We can have the offer process concluded in just in a space of just about 2 months maximum. That's what the market expects, and that's why market is being punished at this time.
Okay, sir. So now that takes me to my final question with you. So we have just about approximately 2 weeks to the end of January. We've already spent 2 weeks halfway. So what are your expectations for the month of January, which is a month which you really can't, we have what we call the January effect. So are we likely to see that January effect on the market, or is that over?
It's still not over, but what I'll just say for that is that we'll see. I'm expecting that those companies that have completed their offer process, especially the SEC has approved their allotment and other things have taken place. So we expect them to get listed on the exchange. Once they are listed, we'll see activities there. But 2025 is going to be a different year for the market because a lot of things will happen. Government itself has said that it's going to be making use of private capital in funding some of those infrastructure projects. So for that reason, we are going to see more activities in the market going forward. So the investors will not wait for those activities to come up before they start investing. Those who want to take position ahead of what the impact of that on the market will start taking that in January. So we'll see still a bit of profit taking will still be there, but we'll see bargain hunting going ahead. But it's just a missed position at this time. But before end of January, I think we'll see a slight change in that. We see more improvement because of what government will be doing, in some months ahead.
I'm sure investors can't wait to see that materialize, because that's where they put their money in and expect better returns, which, of course, the stock market, Nigerian stock market, has been delivering, making it one of the best performers around the world. So thank you so much for your time on the show, Mr. Tajudeen Olayinka, investment banker and stockbroker, giving us details about the market at intraday and what to expect for the remaining part of January. Okay, so from the domestic stock market, as well as some other markets on the African continent, we go over to the Middle East, where I see that the Middle East numbers there, the numbers we see, only the Dubai index was down 0.24%, 5,238.38. For the Abu Dhabi index, also in the United Arab Emirates, it was up by a tad 0.2%. 9,514.98, if that's what I see on the screen there. And then for the Tadawul, it was up by 0.17%. 12,233.41, the Qatari Stock Exchange. All of them are all climbing on the right, on the back of the higher oil prices climbing, and a ceasefire agreement announced between Israel and Hamas. So that is having some impact on the markets around the Middle Eastern side of around the world. Okay, so now for the U.S. markets, where we fly over, we see that the stock futures, they're climbing, and this is because of the blowout earnings from some of the big banks. Yesterday we saw JP Morgan releasing. JP Morgan is one of the big banks there, so reporting better than expected quarterly results. That's for the fourth quarter of 2024. So the stock futures there, we see the Dow Jones Industrial Average, we see just a bit of a pullback there, 0.03%, 42,455. 0.00, while the S&P 500, 5,000, almost at the 6,000 level, 5,998.75, up by 0.16%. And the NASDAQ, obviously, the likes of Tesla and the likes of NVIDIA making some imprint there. They were up by 8% and 3% respectively. So they made that market futures to be up by 0.31%. So what's to expect for the market? We expect that Morgan Stanley, as well as the Bank of America, will report their earnings results later today. Also, the December retail sales. So far, we've seen two economic reports from the U.S. side. We first had the Producer Price Index, the PPI. We also had the CPI yesterday, all coming quite favorable to the market. So the December retail sales is expected to show an increase of 0.5%. But in contrast to what you saw in November, that's down from the 0.7% recorded within the previous month. And lastly, we're also expecting that weekly jobless claims will be out on Thursday. So that's a wrap for the U.S. market. And for the Asian markets, we see that the Asian markets, they're also mostly positive there. We see, first of all, from for the Nikkei, which is Japan's stock market, it's still within the 38,000. It hasn't been able to climb back into the 39,000 points, but it's up by 0.33%. Hang Seng Index 1.23%, up 19,522.89. And then South Korea, which has been in the news for political reasons, which at some point we also see that on the economic side, on the market side, that the market, the Bank of Korea has kept its interest rate surprisingly unchanged at 3% against a 25 basis points, which it was expected to lowered. So the markets are also reacting to that. And as far as the Asian markets are also concerned, we have it here that Japan, the country's annual producer price index, it climbed to by about 3.8% in December, and that's in line with expectation of economists. For the Hong Kong index, it was also up in the final hour of trading, as well as the other markets within the Asian region, all for the close of Thursday's trading session. So, Ladi, I think that's a wrap for the markets that we track, major markets around major parts of the world. So, nothing much, but we're still putting our eyes on Nigeria's stock market, which we hope does not go below the 100,000 points.
And it's quite interesting. You mentioned Bank of America results there. That's out at this point about 2 minutes ago, breaking. As we see, they reported higher profits as its traders, they benefited from a flurry of activity in the fourth quarter, while the lender predicted it would earn more interest income in 2025. So they're giving a positive forward guidance, and I'm sure that's going to impact the stock, at the close of trade today. But Anita, thank you so much there for breaking it down. And it's quite interesting to see you on that side.
I think after more than almost 4 years hiatus, which was within the time of COVID, we're back, and this is not a one-off. We will continue to give you the market reports, as well as some other events happening here live on Business Incorporated.
All right, thank you so much, Anita, and I'll see you later on when you return. Thank you. All right, let's get a check on what's playing out in Europe now. You see, aerospace giant Boeing's had a rough week with some weak numbers, disappointing many in the sector. The US-based playmaker seems to be stuck in a major crisis, and that lets the pan-European competitor, that's Airbus. Airbus is shining at this one. So Lars Holter is with DW and joins me now from Berlin. Great to have you, Lars. So what's the current situation at Airbus and Boeing?
Yeah, thanks for having me, Ladi. Hi. Well, let's start with some numbers, in particular with those Boeing numbers that we have just gotten. The American plane maker has delivered 348 planes last year, and that's disappointing even in the company's current environment, which was, of course, well known to investors and analysts. The company has been, obviously, as we all know, in deep trouble ever since those two plane crashes in 2018 and 2019. Those initially, as you probably remember, led to the entire MAX fleet being grounded. Then, of course, there was tons of other quality issues, not at least just last year, that door that came off an Alaska Airlines machine mid-flight and could have easily led to another disaster. Anyway, in the US, the FAA is keeping Boeing on a very short leash, checking everything twice here, and that obviously has hurt their production. So, as I said, and we should really remember that number, 348 planes. Airbus, to compare it, has delivered 766 planes last year, the pan-European competitor here. They are going strong. The order books are full, and the company even has little debt, just over 13 billion euros, compared to Boeing's 56 billion euros. Investors, of course, also took note. If you just look at last year, including today, Airbus up 10%, Boeing down 30%.
And, looking at Boeing, we know they're mostly the headlines for, most of the wrong reasons, in the previous years. Do you see that happening, in 2025?
Well, let's just hope for now that the headlines, the negative headlines, let's say the disasters and everything and the technical problems will stop. But then, of course, many at Boeing and at Airbus also are wondering, will this race that we once had between these two aircraft makers, will it tighten again? And right now, it actually doesn't look like Boeing can do much there to get back in touch or near where Airbus is right now in terms of revenue and profit. But at the same time, Airbus, and that's what I'm hearing from experts in Frankfurt, but also across Europe, actually, Airbus has to be really careful not to lose its advantage, because they seem to be making a couple of things that are raising eyebrows right now. Airbus has recently started a buyback program. Up to 10% is actually pre-approved by investors, and it's just unclear whether that is wise, because buying back shares and putting investors' interests first was exactly what has downed Boeing to begin with. That company bought back shares and suddenly had less money available for research and development and also for quality and safety control. Now, some insiders here are warning that the European competitor can fall into that same trap. Wouldn't even be hard to imagine such a scenario, because with Boeing not really that strong anymore, Airbus doesn't have competition. So why would they be innovating? Why would they need to invest tons in building up, for example, a new platform? One can only hope that they don't lose sight of their core business over their recent success.
Yeah, I remember, how they kicked off 2024 in January there with a panel fitted over an unused emergency exit door. That fell off one of those, brand new planes. I hope they kick off 2025 on a stronger foot. But as for the markets now, how's it looking? We know a lot of data coming out there and, flurry of results from most of the companies in Europe. How's it looking?
Yes, indeed. Earnings are pouring in. We seem to be getting right into the heat of earnings season. And they're all, of course, shedding some more light on some of the companies last quarter and, of course, then 2024, because it was obviously Q4 here. Now, before we get to some German numbers, I think we should mention Stellantis, because we've seen quite a few numbers over the last couple of days from the auto sector, including, of course, all of the German ones. And now Stellantis is, of course, the car conglomerate behind Germany's Opel, but there's also France's Peugeot and Citroën, Italy's Fiat and Alfa Romeo. American brands are in there, Chrysler and Dodge. So this is truly a multinational car company, but their problems are exactly the same as the German car makers and everything else we've heard over the last couple of days. There's a drop in demand, there's less revenue, but shares are okay right now because the company says they sold off much of their inventory and they're quite optimistic for a little bit of a turnaround. Now, in Germany, online retailer Zalando is the big winner of the day. Their stock's up more than 10%, and that's after strong numbers. And that is certainly a good thing, as a strong retailer tells us a bit about a possibly stronger consumer, and we can certainly use some positive news there. So that stock's up. The German DAX itself is up too, the blue chip index, but just by a tad, by right now at about 0.25%.
All right, we'll definitely keep tracking to see how they perform. Most of these earnings are rolling in at this point. Thank you so much, Lars Holter in Berlin. Thank you.
Yeah, thank you, Ladi.
All right, let's get to some stories now. On the African continent, we see Fitch ratings. They're optimistic about recovery of Ghana's banking sector. They're citing stronger profits and improved capitalization following the challenges of the domestic debt exchange program, DDEP. The agency forecasts a brighter outlook as economic stabilization efforts progress. Fitch's latest report credits high Treasury bill yields for driving bank profits over the past 2 years, helping restore capitalization after the DDEP-related losses. Despite the setbacks from the debt restructuring initiative, Fitch predicts most banks will meet capital requirements by the end of 2025. The sector's reliance on domestic deposits has also provided stability, shielding banks from liquidity challenges faced in other markets. Let's take it to East Africa now. See, the Kenyan government is moving to transition all counties to the Treasury single accounts as a TSA to streamline public fund management and improve cash flow efficiency. The TSA is a unified system of government bank accounts designed to consolidate and optimize the use of public funds. As part of this shift, the government is also transitioning from a cash basis to an accrual accounting system to enhance financial reporting and strengthen the management of public resources. All right, so another conversation now. See, the Nigerian carbonated soft drink market is a major player in the country's beverage industry, dominated by well-known brands. However, despite intense competition, consumers have witnessed a significant price increase in recent times. Let's explore the factors driving the price surge, including the impact of rising input costs, government policies such as sugar tax, and the potential impact of declining global sugar prices. Well, join us for this conversation. We have Rosemary Ohira, as an analyst with FDC. Great to have you, Rosemary. So talk to me about this price increases. A 50 cl bottle of carbonated soft drinks, that increased by about 66.67% in the past year, surpassing current inflation rate of 34.80%. That seems to be a trend we see these days in the market. Tell us about this.
Good afternoon, Ladi. Thank you for having me. So the reason for the surge in the price of carbonated soft drinks, it can be attributed to two main factors. The first is currency denomination issues, while the second is the increased cost of production for manufacturers. So for currency denomination issues, for this commodity, just like any other commodity, it has to be traded at a price point that is both convenient and available. For instance, if a consumer goes to a retailer and wants to get, say, a bottle of Coca-Cola, the retailer buys this commodity in a pack of 12. So let's say the price for the entire pack of 12 is divided by the number of units in the pack. Let's say it gives the retailer a price point of 417 naira, and let's say the retailer wants to sell for 450, for instance. As a balance, the retailer has to give the consumer a 50 naira note and a 500 naira note if the consumer brings a 1,000 naira note. So this puts a strain on the transaction, because most of these currencies in the lower end of the lower denomination are currently phasing out of circulation because of their significant loss in value. It is much easier for the retailer to give the consumer a 500 naira note for a 1,000 naira balance instead of a 500 naira note and a 50 naira note. So on the side of increased cost of production, in Nigeria, we've seen frequent devaluation of the naira against major currencies. And this has put an upward pressure in the price of factor inputs used in the manufacturing of this commodity. And with increased cost of production, manufacturers are likely to pass this increased cost to consumers in form of higher prices. So these are the reasons why the price of carbonated soft drinks have increased astronomically recently.
And talking about inputs, now we see there's a projection that there'll be a 6.8% drop in global sugar prices in 2025. So can we expect lower prices for these carbonated soft drinks in Nigeria?
Indeed, the price of sugar has been reducing since 2024 and is still expected to reduce well into 2026. But sugar is not the only factor input that goes into the production of this commodity. There are several other things like operational costs, cost of distribution, and other inputs like flavoring, the carbon dioxide, and all. So if the price of other inputs are increasing, we will not see, at best, we'll see the price of carbonated soft drinks being stable. At worst, we'll see only a soft decline, but we should not expect any major decline in the price of this commodity, except if the price of all other factor inputs are either declining or remain stable.
Right, it's quite interesting, when we see the prices of most of these global inputs, when they go down, in the global market, it doesn't seem to impact the cost of the product. When it's in the country, it doesn't normally go down, but we see the prices, take for instance, oil prices. We see oil prices, go down, but PMS prices still stay quite stable. They don't usually go down. So I guess that's the same dynamic there with sugar prices and most of these markets. But what are you seeing for sugar tax at this point? How do you see that impacting, the price of these drinks, going forward?
The sugar tax, we can look at it in three different ways. For one, price increase. The second is demand reduction. And the third is adaptation, or the need for adaptation in the market. So the sugar tax has caused an increase in the price of this commodity. So this has affected demand, especially for low-income consumers who are more sensitive to price changes. So this has caused a reduction in the demand of this commodity. So for producers now, this has created a need for them to re-strategize. So we have some producers producing at smaller quantities. So we have like those smaller PET bottles, while other consumers are reformulating their products to contain less sugar, so to mitigate the effect of this tax on their profit margins.
All right, we'll keep tracking to see. Hopefully, some of these prices just cool off and, consumers get a break in 2025. Thank you so much, Rosemary Ahira, analyst with Financial Derivatives Company.
Thank you, Ladi.
All right, to other stories now. The International Monetary Fund Board of Directors, they're meeting this Friday to review Ethiopia's progress on this $3.4 billion loan program. The meeting will finalize the second review of the program following a staff-level agreement announced last year. However, Ethiopia still needs to restructure its debt with creditors before it can proceed further. Let's get a check on what's playing out with the markets now. We're still seeing a green picture there for the total. For the crypto market, that's according to Coin 360. I will see, my director telling me the land is green. Yes, it is really green. Bitcoin, $99,332, up 2.51%. So we're seeing XRP having a monster rally at this point, breaking back above $3. I feel like that was the last high, XRP, got to about that level, about $3. Let's look at some headlines now in the market. We see Upbit crypto exchange, one of the largest cryptocurrency exchanges in South Korea, has reportedly received a suspension notice for alleged Know Your Customer violations, KYC. Financial Intelligence Unit of South Korea's Financial Services Commission notified Upbit of possible punitive measures related to the alleged KYC violations. Now, we also see Federal Tax Authority of the United Arab Emirates issued a clarification regarding VAT for those dealing in cryptocurrency mining. As part of the clarification, individuals who are crypto mining for themselves will not incur VAT tax. However, if they're mining for others, offering it as a service, they will need to pay VAT. And that's the UAE VAT tax rate, about 5%. Then we see the U.S. government, they filed a court submission to return stolen funds from the 2016 Bitfinex hack to the exchange as a restitution in kind. The assets include approximately 94,000 Bitcoins and unspecified amounts of Bitcoin Cash, Bitcoin Gold, and Bitcoin Satoshi Vision. That's BSV. Let's bring in Olumide Adesina now, financial market analyst. Hello, Olumide.
Hello, Ladi. Good afternoon.
Good afternoon, Lumide. So from a very red weekend into Monday, we're seeing the market pick up with Bitcoin there, trying to challenge $100,000 again. But it looks like the big shiner right now is XRP.
Yeah, it has been a tremendous week. Looking at the price action, at some point we thought that Bitcoin was retracing back below the 89,000 support line. However, appetite for risk resumed. You know, the CPI data really brought in so much glamour. But just like you mentioned, the third most valuable crypto asset, XRP, has been on fire. It broke above the $3 mark and settled around, as we speak, between 2.9 and the 3.10 range line. That really tells you that investors are really priced the fact that Ripple's XRP, a token usually known for remittance and has strong affiliation with global banks, particularly Japanese banks. Investors are pricing that the ecosystem will benefit from a Trump presidency. You recall that Ripple spent millions of dollars, you know, in the previous election that brought in Donald Trump. And also, we're having a crypto-friendly Congress. So investors are excited. But, Ladi, if you look at the price as we speak, it seems that the 100,000 is looking more like a resistance rather than a support, because at two occasions, we saw Bitcoin breaking above, but the bulls do not have the energy to maintain that line. But Solana, XRP, major altcoins, I think they're on fire. Ethereum, as usual, being a disappointer. We've seen that Ethereum really lacks that luxury to break above the 3,500 support line that has now turned to resistance. It's really very unfortunate for a token that has ETF exposure. Investors really have a lot to talk about.
Right, and you know, talking about XRP, the last time XRP hit a high above $3, that was $3.84, January 4th, 2018. That was 7 years ago. And it looks like it wants to revisit that level, you know, again. Do you see that as resistance?
I think it's more of the odds are more in XRP favor. The fact that it also Ripple, the ecosystem now has a stable coin, and is becoming the fastest growing stablecoin just behind Circle USDT. It tells you that the ecosystem is becoming systemic. However, they still have an upskill battle, despite the fact that Gary Gensler is departing a few days' time. A lot of pundits are saying that we still have anti-crypto Antonis in the United States Securities and Exchange Commission, and that's why we saw the morning brief yesterday when the commission tagged XRP as a security. If that plays, if Ripple loses that lawsuit, definitely the $2 support will turn to resistance, and that's why a lot of bookmakers are really watching that case closely, Ladi.
Okay.
Yeah, it's really possible, but the odds are still out there, you know.
Right, and you definitely, we know the way FOMO. We know how the fear of missing out, we know how that impacts most new investors, you know, in this market. Yeah. Some will think, okay, this is the time to jump on XRP, you know, at this price. How are you seeing the risk reward here?
I think the upside is not as much as what a lot of points, because the Trump presidency would definitely shake the market. We're seeing the market be shaken from different reports about U.S. tariffs to record debts and the China's contraction in terms of deflation in that second most powerful economy. Ladi, to be honest with you, I don't see XRP doing a $5-6. So I think investors should take profits and allow their wins to run.
All right, we'll definitely watch out. And we know, you know, XRP and XLM, that's Stellar Lumens, they have that relationship. They've had it for the past 7 years or more, and it seems like that relationship remains.
Yeah, because you look at the architecture behind the remittance-based token, it's similar, the tip. But I think one of Ripple's advantage is that it has institutional relationship. There's hardly any top bank that doesn't have an affiliation with XRP. There was a time UBA and Ripple had something going on before the CBN ban. So we hope to see the XRP ledger in our banking system. However, XLM is really showing attraction among retail, and the price still looks attractive compared to Ripple. So yeah, I think it's an option, but you can't take the shine away from Ripple.
Yeah, the shine stays with Ripple at this time. Thank you so much, Olumide Additional, financial market analyst. Thank you.
Thank you for having me, Ladi.
All right, there you have it. So that's what's playing out in the market right now. XRP having that monster rally, and most markets we track, I'm still trying to decide on which way to go. With the local boss still looking like it might trade in negative territory. But thank you so much for watching. I'm Ladi Williams from me and the team right here at Channels HQ. It's bye for now.